Hello, friends, and welcome to my YouTube channel Simply Stocks. And today I'm going to talk about HFCL, one of the stocks that went up sharply in 2017-18, but is now back to its levels that it was showing in 2015-16. So, what has happened? What has gone wrong? And why the stock has halved from its near time high? We'll understand that, and what needs to be done. We'll discuss this. So let's get started. First of all, a disclaimer that this is not a stock recommendation. People taking any position into any share that I talk about should do that with their own due diligence and research. And I'm not in favor or against any company that I talk about. Now about the company, HFCL was established in 1987 and it provides the telephonic equipment, or it is a telephonic ancillary play. Just like there are two or three other telephonic equipment companies that are listed, HFCL is also one of them. They also provide broadband hardware solutions, and that is why the stock really went up during 14 to 17 period, because the government was pushing for digital India and with internet for nearly all the people here in India in the next 6 to 8 years. And hence these companies went up sharply, including HFCL. Their products include optic fiber cables, power electronics, and optical transport networks. So they provide they provide in a sense a complete telecommunication network solution. About the numbers, well, the company is of a market cap of 2,300 crores. The sales was down around 19 to 20%. This is the September quarter latest numbers that I'm talking about of FY20 compared to FY19. So the sales have been down around 19.5%. The profit is up 30% owing to lower raw material cost of optic fiber and other materials that goes into the production of the telephonic equipments. And because of that lower cost, they had lesser expenses, and that's why the profit has gone up by around 30%. But what has been alarming has been the debt. So the debt has nearly doubled at the moment, and the margins have increased only because of the lower cost, as I just mentioned, not because of any operational efficiency, and that one needs to look at. So do not go by merely looking at the top line and bottom line. Go into the different aspects of the numbers before you invest into any company. It trades at 8-9 times earning, which is not very expensive but not extremely cheap, because I have seen these companies trade at 3 to 4 times around 2014. So why have the stock fallen? There have been multiple reasons. I have pointed out here six major reasons of the fall in the stock. The debt has ballooned. To 514 crores this quarter, compared to 298 crores. This was in FY19, and it has gone up even further, and 298 crores was in FY18. So the debt has gone up manifold, around 70%. So the debt has uh, gone up by 72%. The interest burden has increased by quarter on quarter 2.2%, which is quite significant. Actually, it's not 2.2. I want to make a clarification here. It's 22%. So the interest burden has gone up by 22% quarterly, and the sales have been dropping sharply. And this is the major reason why I believe that one needs to take a look, because any company that does not grow in terms of profitability, one can understand that because of external reasons, because of economy, etc., they might not grow. It might not grow on the bottom line, or it might show losses. But sales, if the sales are growing, say 18-20%, 30% year on year, eventually profitability would come in. But here, when the sales are dropping, that means they are losing market share. The company is losing market share, and this is alarming. And in that sense, one could look at other companies and their sales, and you would know that where the market share is going. and that's why people are avoiding. This is also one of the major reasons that the sales are dropping, and there have been more competition, and hence the profitability is projected lower, because raw material cost would not remain at the lower level. As I have just mentioned, it will keep fluctuating, and if the company doesn't do operationally well, then the performance of the company would drop over a period of 1 to 2 years or 6 to 8 quarters. One needs to understand that once the sales starts dropping, uh, you need to be very vigilant in order to invest in such companies. Uh, Major reasons out of this is that I have come to know is about debt, because of the high debt. And one needs to also understand that when I looked at the shareholding pattern, the promoter holding is not a lot, not more than 50%, is less than 50%, nearly around 34 35%. And there is a high pledge of that holding itself, around 68% of the promoter holding is pledged. That is a lot. And probably 20 to 30% is manageable, but when you have 68% of your promoter holding pledged, and with the pledging being such a bad word in the environment today, people are staying away from such a stock. So one is to know understand that in 2015-16 we had that run in small and mid cap and in all sorts of shares, including HFCL, and we saw the company go from 11 rupees to 34 35 rupees, 3x in no time. And now it has dropped to 17 18 rupees. Probably it will not fall, probably it will go to 14 15, but you'll not make a lot of money, because people are looking for quality, people are looking for good stocks. Even in mid and small cap, there have been companies that are going up in mid and small cap, which are debt free, which are pledge free, etc., and producing good sales numbers and profitability numbers. Sector slowdown is another reason why we have seen a lot of selling in this sector, be it HFCL, be it other telephonic or ancillary firms, or firms that provides optic fiber. I'm not going to name them here, but one of the names that come to mind is Sterlite Tech. So you saw how it has fallen from 320 330 to around 140 130. So everything is falling down in this sector, and one needs to avoid in that sense the sector itself at the moment. So my call in the stock is that you need to sell on every rise, but not, that doesn't mean that you just sell when it goes from 17 to 21. Wait for a major small cap rally. I believe a small and mid cap will rally soon, probably in the next 4 to 6 months. I'll put up a video on this sector as well soon. But the move could come in any time, because I think the valuations in the Nifty is very rich. So wait for that big move, and then exit the stock. Avoid it if you don't have it, and wait for results to turn around, wait for the sales numbers to grow, wait for the management commentary and the market share to increase, and then invest. The whole sector is under pressure, and you need to understand that. Put in money into cash generating businesses such as Britannia, Nestle, etc. But don't go for Britannia, Nestle. I'm not saying that it's a stock recommendation, but look for businesses which are generating cash, which have no debt, which have very low debt and very low pledging or no pledging. And remember to put only 5% of your total investment into any mid or small cap stock, so that if you lose all of it, you'll still have 95% intact with you, and you can recover the money fast. So this was my video on HFCL. Please like and subscribe my channel, hit the bell icon so that you can get my video straight away when I post it. Thanks a lot for watching.